Marcus puts $500 a month into his 401k, every month without fail. His coworker Dana does the same amount, same consistency, but she puts it into a Roth IRA instead. 30 years later, they both have over $600,000 sitting in their accounts. Same deposits, same market returns, and they're both completely convinced they made the smarter choice. Only one of them is right, and the reason comes down to a single number neither of them calculated when they were 28. Most people approach this decision like it's a coin flip. Pick one, stay consistent, retire rich. Financial forums are full of confident answers. Subreddits have entire threads dedicated to declaring one obviously superior to the other. And yet, the actual math, the real full picture, depends on a set of variables that almost nobody knows about themselves at age 25 or 30. That's not a flaw in the system. That's just the uncomfortable truth underneath a very simple-sounding question. So let's actually run the math, not the simplified version, the real version. To understand what's actually at stake, you have to start with what these accounts fundamentally are, not what they invest in. That part's the same. Stocks, index funds, bonds, whatever allocation you choose. The difference lives entirely in when the government collects its cut. A traditional 401k takes your money before taxes touch it. You earn $5,000 this month, you contribute $500, and the IRS only sees $4,500 as your taxable income. You get the tax break now. The Roth IRA flips this completely. You contribute after taxes. That same $500 comes out of money you've already paid tax on. You get no break today, but decades from now, when you pull that money out, it comes out completely tax-free. That's the whole game. Pay taxes now or pay them later. The answer to which one wins depends almost entirely on a question that sounds simple but isn't. Will your tax rate be higher now or higher in retirement? If you're in a lower bracket now and expect to be in a higher one later, Roth wins. If you're at your peak earning years and expect to drop significantly in retirement, traditional wins. And if you have absolutely no idea where you'll land in 30 years, which is most people, both options carry real risk in different directions. Here's where it gets interesting. Take Marcus. He's 29, earns $85,000 a year, and contributes enough to his 401k to hit the IRS annual limit, $23,000 in contribution terms as of recent years, though that limit does adjust over time. He's in the 22% federal tax bracket right now. Every dollar he puts into the 401k saves him 22 cents in taxes today. Over 30 years of compounding, that's not a small number. Dana is almost in the same situation. Same income, same age, same market returns, but she contributes to a Roth IRA, which is capped at $7,000 annually under current limits. She hits that ceiling and stops.
Right there, before any tax math, Marcus is putting in more than 3 times what Dana is each year, simply because the 401k allows larger contributions. That gap compounds over 30 years into an enormous difference in account balance. This is the part of the conversation that gets skipped constantly. Contribution limits are not the same, and for people who can afford to max out, that discrepancy matters enormously. But let's be fair to Dana. The contribution limit difference is real, but it's not the only number that matters. Assume both are contributing equally, say $500 a month, and both get identical 7% average annual returns. After 30 years, they're both looking at roughly $567,000 in raw account value before any withdrawals. From the outside, identical. From the inside, completely different. Marcus pulls out $567,000 and owes income taxes on every dollar. If he's in the 22% bracket in retirement, which isn't guaranteed but isn't unusual either, he walks away with around $442,000 in actual purchasing power. Dana pulls out $567,000 and owes nothing, zero. Federal taxes, gone. She keeps the full amount. In this scenario, Dana wins, and this is the calculation that fills the internet with Roth evangelists. The visual is clean. One person hands 22% to the government, one person doesn't. Obviously, you'd rather keep your money. But here's what most people miss. That scenario assumed Marcus doesn't reinvest his tax savings. That's a quiet assumption that quietly breaks the comparison. When Marcus contributes $500 to his 401k, he didn't actually spend $500. He deferred $500 in income and avoided paying $110 in taxes on it, based on a 22% bracket. That $110 is real money. If Marcus invests that tax savings somewhere else, the comparison shifts dramatically. He now has his $567,000 account, taxable on the way out, plus a separate investment account that grew from years of reinvested tax breaks. This is the scenario financial planners call the true apples-to-apples comparison, and it almost never shows up in the casual 401k versus Roth debate. Because it requires discipline. It requires that Marcus actually invests those savings rather than spending them. Most people don't, which is exactly why the Roth tends to outperform in practice, even when the technical math is closer than it appears. Human behavior is part of the math, too, and the 401k system hides money from you, somewhat by design. You never see it, so you never miss it. The Roth doesn't have that cushion. You write the check from post-tax income. You feel it, and that slight psychological friction is actually one of its quiet advantages. Now let's talk about the scenarios where a traditional 401k genuinely wins, because this isn't a one-sided story. Consider someone at 52, high-income years, likely peak earnings, probably sitting in the 32% or even 35% federal bracket. Contributing to a 401k at that tax rate means every dollar deferred saves 32 cents now. Then in retirement, at 65, if Social Security is modest, if pensions don't apply, if they draw down carefully, they might land in the 12% or 22% bracket. They paid less on the way in than they would have on the way out. That's a genuine tax arbitrage. The traditional 401k works beautifully for this person.
The problem is that 52-year-olds weren't always high earners. They couldn't always predict this would be their trajectory. Most people making this decision are 25, earning $55,000 and trying to forecast their financial life across 4 decades of uncertainty. Nobody told them that the answer actually requires knowing their future tax bracket. There's another layer that almost nobody brings up early enough: required minimum distributions. Traditional 401k accounts and traditional IRAs force you to start withdrawing money at a certain age, currently 73 under recent law. The IRS built in a mandatory withdrawal schedule because they've been waiting 30 years to collect those deferred taxes, and they're not going to wait forever. These required minimum distributions can push you into a higher tax bracket in retirement even when you didn't plan to spend that much. They can affect how much of your Social Security is taxed. They can increase your Medicare premiums. The 401k tax break you took at 28 is still generating tax consequences at 75. Roth IRAs have no required minimum distributions during the account holder's lifetime. You can leave the money growing as long as you want. For estate planning purposes, for legacy wealth, for people who genuinely don't need the money at 73, that flexibility is worth real dollars. Nobody explains this part at the office benefits enrollment meeting. Then there's the state tax dimension. This is where it gets genuinely complicated. Some states don't tax retirement income at all. Some tax it heavily. If you live in California during your working years and plan to retire in Florida or Texas, you paid California income tax on every Roth contribution you made. You could have deferred that tax through a 401k, moved to a no-income tax state, and withdrawn money paying 0 state taxes, plus a potentially lower federal rate. The geographic arbitrage from traditional accounts is a legitimate strategy that rarely enters the conversation. The reverse is also true. If you live in a no-tax state now and retire in one later, the traditional route looks more appealing from a state tax angle. Context is everything here. Nobody's situation is universal. Let's also talk about what happens when life doesn't go as planned, because it usually doesn't. Roth IRA contributions, not the earnings but the original contributions, can be withdrawn at any time without penalty or taxes. You put in $7,000 this year, and if you genuinely need it in 2 years, you can take that $7,000 back without the IRS caring. The earnings stay locked until 59.5 under normal rules, but the contributions are accessible. This is meaningful flexibility that 401ks don't offer in the same way. Early 401k withdrawals generally trigger a 10% penalty plus income taxes. The Roth has a built-in emergency valve that most people don't realize they have. This doesn't mean you should use a Roth as a savings account. The whole point is to let it grow untouched. But for someone in their late 20s with no emergency fund, no real financial cushion, and some anxiety about locking money away, the Roth's flexibility is a real psychological and practical benefit. So where does all of this actually land? The honest summary is that there is no universally correct answer, and anyone who tells you otherwise is simplifying in a way that could cost you money. The decision is a tax timing question with 4 key unknowns: your current bracket, your future bracket, your state of residence, and your spending behavior. If you're early career, lower income, expecting significant raises, the Roth advantage is real and meaningful. If you're at peak income, planning to downshift dramatically in retirement with careful withdrawal planning, the traditional 401k has genuine edge.
The most common answer financial planners give is also the most practical one. Use both. Many employer 401k plans now offer a Roth 401k option, which gives you the higher contribution limit of the 401k structure with the tax treatment of a Roth. For people who qualify for both and have the cash flow to contribute meaningfully, splitting contributions across traditional and Roth accounts creates tax diversification. You're hedging against uncertainty. Some of your future money will be taxed, some won't. You win in multiple scenarios instead of betting everything on one tax rate prediction. It's not the dramatic answer. It doesn't win arguments on the internet. But it's how a lot of people who actually understand this stuff structure their own retirement. One more thing that changes the math entirely, and it's probably the most overlooked factor in all of this: the employer match. Many 401k plans include a match, say 50% of contributions up to 6% of your salary. That's a guaranteed 50% return on that portion of your contribution before the market does anything, before taxes, before compound interest. A 50% instant return. Almost nothing in personal finance competes with that. If your employer offers a 401k match and you're bypassing the 401k to put money in a Roth IRA first, you're leaving free money on the table. The match alone justifies funding the 401k to the match limit before doing anything else, regardless of which account you philosophically prefer. After the match, then you have a real choice to make. Marcus and Dana both retire. Marcus has paid his taxes and has less purchasing power on paper, but he funded his account more aggressively, reinvested his early tax savings, and claimed his full employer match every year. Dana kept every dollar tax-free, had more flexibility in her 40s when things got uncertain, and never worried about required minimum distributions. Neither of them made a catastrophically wrong decision. Both made reasonable choices that worked, because they made a choice and stuck with it. The actual enemy of retirement isn't choosing the wrong account type. It's choosing nothing. Overthinking the 401k versus Roth question for 3 years while contributing to neither. It's starting at 35 instead of 25. It's pulling money out early because the flexibility was there and the discipline wasn't. The math between these two accounts is genuinely close for most people in most situations. The math between starting now and starting later is not close at all. A decade of compound growth doesn't come back. Tax bracket decisions do. You can adjust contributions as your income changes, convert traditional accounts to Roth in lower income years, restructure in retirement. You cannot manufacture lost years. Pick the account that fits your situation today, automate the contribution so you never see it, and revisit the strategy when your income changes meaningfully. That's it. That's the real answer. Not the satisfying one, but the one that actually works.